Yes, friends, now welcome back to one more topic, which was a special topic actually. See, what happened since past a few attempts, Institute has started asking us a combination of questions. Some part of process, some part of joint product, byproduct, some part of operating costing, some part of absorption, some part of absorption, some part of marginal. Now, all these questions cannot be covered unless you know all the topics of your syllabus. So what we have done, we created a separate topic called as application, and we shifted all these questions to that topic. So when we solve application as a last topic, you're already done with the entire costing. So it becomes easy for you people to understand. Like I already said, job costing, batch costing, you might find them as a separate topic in the study material, but it is already covered in our material in material costing, labor costing, and absorption costing. We have solved so many questions on job 1108, job 1324, job ABC, then batch wise calculation of that muffins question we solved, then EBQ, economic batch quantity, we calculated. So that part is taken care of, you don't worry about it, not as a separate topic but as a part of some other topic. But these special questions were to be done. So let us have a glance on application topic, a few questions. Question number 1 was about a project cost sheet. They told us, they gave us salary of 3 different categories. They gave us salary of 3 different categories. On the basis of this, we found out how much is per month salary of each person. So 15 lakhs per annum is a salary of software engineers. Each one is getting 3 lakhs per annum. That means it is 25,000 per month. 2 project leaders are getting 9 lakhs. That means each one is getting 4 lakh 50 for the year. For 1 month it is 37,500. Project manager is getting 6 lakhs. For 1 month he is getting 50,000. We had 30 lakhs salary and 15 lakhs overheads. The only important point in this whole topic, whole question was, we were supposed to prepare cost sheet for a project XYZ for 6 months. So entire salary structure was covered on the basis of that. Now there were 3 software engineers, 1 project leader, and your project manager was spending only 2 months. Okay, so what we did was, this is what we did. 25,000 per month will be paid to 3 software engineers for 6 months. 37,500 per month will be paid to 1 project leader for 6 months, but project manager who is getting 50,000 as per working note 1, he is getting 50,000 per month, but he is devoting only 2 months to this project XYZ. So only 2 months salary was charged. And then we realized that all other expenses, traveling, depreciation was also calculated by way of working note. 50,000 was a cost of 1 laptop. Estimated scrap value was nil, and the estimated life was 2 years. So basically it is 25,000 per annum, but we want it for 6 months. So 25,000 per annum into 6 by 12. This will give you depreciation of 1 laptop, and we were having 2. So we are back to 25,000. That was a depreciation. Traveling expenses were charged, and apart from, as I said, apart from labor cost of 30 lakhs, there was overhead of 15 lakhs, which was also to be charged to the customer. This belongs to the company. Company is spending 30 lakhs on labor, and at the same time company is spending 15 lakhs on overheads. So you can take that as a base. No, absorption rate can be based on labor cost. So 15 lakhs is my overhead figure when 30 lakhs is a labor cost. That means it is 50%. So out of 30 lakhs, if 7,75,000 is getting charged here, 50% of it will be charged as overheads. 50% of it will be charged as overheads. So wherever 30 lakhs goes, 15 lakhs will be there. So any part of 30 lakhs if you are transferring or charging to one particular project, overhead will be charged to the extent of 50%. Total labor 30, total overheads 15. Okay, so if I'm going for a particular project and some part of 30 lakhs is getting charged as wages, 50% of that will be some part of 15 lakhs to be charged. Basically, it was absorption. Then we had the second question saying that we were supposed to calculate cost of processing one application. We had 12,000 as total overheads, and we were supposed to take 25% of it as overhead to be charged to home loan. See, there is a department, loan department, which may have home loan, car loan, loan against property, education loan. Suppose 4 loan products the bank is running or the company is running. The premises are common, certain common expenses will be shared by all these departments. Plus these departments will have their own staff to look after the project. So loan processor's salary is 80,000. Home loan department has got 4 employees having a salary of 80,000. So that will be the first cost of home loan department, plus home loan will have to bear 25% of the total cost structure. 25% of the total overhead cost will be borne by, will be absorbed by, will be charged to home loan department. 80,000 plus 3,000, 83,000. 83,000 was your total, 83,000 was your total cost, which was divided by 100 applications, 830 was cost per unit. So this was the only important part. Again, some absorption part was required. This you will find in your service sector topic. This you will find in your service sector topic. So basically these two questions were nothing actually, but since absorption concept was not done, we couldn't do this earlier. Now question number 3 is already covered in material. You can watch video of material, revision video of material costing. I have solved this question there. Question number 4 is discussed in budgetary control. The last part of the video you will get this, which was a combination of budgetary control and marginal costing. Question number 5 I'll discuss now. This was about fixed and flexible budget. So actual data was for 72,000. Actual data was for 72,000 units. We were supposed to prepare budget, so we converted the whole budget into budget of 72,000 like this. The budget was given for 80,000, so I first wrote the whole budget of 80,000 so that for variable overheads CPU was available and for fixed overheads total was available. Total was carried forward directly, 40,000, 40,000, you can see that. 4 rupees per unit into 72,000 gives you the budgeted sales value of 72,000 because we have sold 72,000. So the comparison has to be at par. Comparison has to be at par. If you want variance to be calculated at 72,000 level, if your actual data is of 72,000 units, your budgeted data must also be for 72,000 units. So it was converted from 80,000 level and it was taken to the level of 72,000. Variable cost per unit like material, labor, variable overheads were simply applied on 72,000 to give you the cost structure. Selling price was also charged to give you the sales value. And we got the budgeted profit figure. We compared actual data with budgeted data to find out variances. So that was your first answer. Again, I told you in the budgetary control video as well. Fixed and flexible budget calculation. Simply focus on the breakup of cost. How much is variable, how much is fixed. For variable, focus on CPU. For fixed, focus on total. If you come across any semi-variable cost, break that into 2 parts. Merge variable with variable, start focusing on CPU. Merge fixed with fixed, start focusing on total. Is this part clear? That's what we did here. After this, they asked us to calculate variance. Oh my God. The standard was available here for 1 unit. For 1 unit, I was supposed to consume 1 kg and I was supposed to work for 1 hour. So if my actual output is 72,000, if my actual output is 72,000, if my actual output is 72,000, this is what I'm supposed to get. When I apply price and rate, I'm getting the standard cost. I compare actual cost with the standard to get the rate, to get the variance calculation done. Now rates, when they are giving you answer in decimals, when rates are not giving you a round figure, please do not round them off. Please do not round them off. Please do not round them off. Your answer will differ. Keep them as it is. Take the full rate for the purpose of calculation. Fixed overhead was also done in the same manner. I extracted information from the question. Budgeted fixed overhead, budgeted actual fixed overhead, budgeted quantity, actual quantity. This was clearly given in the question. Now 1 unit requires 1 hour. That's what the labor data says. 80,000 budgeted units will require 80,000 hours. Whereas the team has actually worked for 70,400 hours. You calculated fixed overhead variances as well. Okay, I mean, you can calculate fixed overhead variances as well. The standard procedure is to be applied. We have discussed that in standard costing. Thus, one special variance which was discussed in this was your margin variance. Sales volume variance analyzes, open your nose and listen to me, sales volume variance analyzes impact of variation in quantity on sales. Sales volume variance analyzes impact of variation in quantity on sales. But sales volume profit variance wants to analyze the impact of volume variance on profit. So 80,000 quantity was expected to be sold, 72,000 units were actually sold. When I don't sell 8,000 units, if I multiply this by budgeted selling price, I will come to know how much is the impact created on, sales. But they asked for profit, no? So I wanted to apply budgeted profit per unit. My budgeted profit was given in the budgeted date 40,000. I knew budgeted quantity 80,000. 0.5 is my budgeted profit per unit, which was applied there. Is this part absolutely clear? We had budgeted profit here in the calculation, if you recollect. 40,000 budgeted profit. 3,20,000 minus 2,80,000. We had this figure with us. So we got it. So sales volume variance will analyze impact of quantity variation on sales, but sales volume profit variance will analyze impact of quantity variation on profit. So instead of multiplying by budgeted selling price, we'll have to multiply by budgeted profit per unit. That was a important part in that. Yes, friends. The next question I wanted to discuss with you people is question number 6 of application topic. Some ratios were asked. It was pretty simple. Please try to understand this. In a day, you work for 8 hours and your 1 week consists of 5 days. So basically, it was 40 hours per week environment. So when you have 50 employees, you can work for 2,000 hours, but you have only 40 employees. So you can actually work for 16. So this is your expected capacity. This is your actual capacity. Because you have 40 employees working for you. You cannot work more than that. They gave us a calculation for 4 weeks. So ideally, you can work for 8,000 hours. This can be your maximum capacity, but your current capacity is 6,400. That means you have used only 80% of the maximum capacity, and that is your actual usage of budgeted capacity ratio. And that is your standard capacity usage ratio. You could have said to work for 8,000. You are keeping your budget at 6,400. So this is standard usage. Now efficiency ratio. Okay. Please understand, your actual hours are 6,400, but standard hours are 8,000. Actual hours worked 6,000. Actual hours expected to be worked for 4. Okay. Standard hours 8,000. So this 6,400 is nothing but this only. This 8,000 is the other data. But you have actually worked for 6,000 hours, and in 6,000 hours you completed work of 7,000 hours. In 6,000 hours you completed work of 7,000 hours. Oh ho ho! In 6,000 hours you completed work of 7,000 hours. Are you efficient? Yes. That means your efficiency ratio should be more than 100. Are you efficient? Yes. Your efficiency ratio should be more than 100. Okay. You are efficient. Your efficiency ratio should be more than 100. When the ratio is more than 100, it is considered to be good. Okay. So the ratio is more than 100. That means the numerator must be greater than the denominator. In that case, standard hours must be the numerator, actual hours must be the denominator, and the formula is standard hours upon actual hours into 100. That's your efficiency ratio. Had it been quantity, I would have gone for actual output upon standard output into 100. I hope you know that much. Since it is about hours, we have to get it this way. Work of 7,000 is done in 6,000. That means it is efficient. The team is efficient. The ratio should be more than 100. If the ratio is more than 100, numerator must be greater than the denominator. So numerator has to be the higher amount. So 7,000 will be the numerator, 6,000 will be the denominator. Oh, so the formula comes into existence. Standard hours upon actual hours into 100. Even this is done. Now activity ratio. Ha 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 ha. Listen. You have a staff which can work for 6,400 hours. Still you have accepted work of 7,000 hours. They said standard hours are 7,000. That means you have accepted work which was supposed to be completed in 7,000 hours, whereas you max to max can work for 6,400 hours because you have only 40 employees. So you are working at 109.375% of your budgeted level. So that was your activity. Calendar talks about number of days. 5 days a week, they said. They're talking about 4 weeks. So 20 was my budgeted period. And then they say there was one special holiday. Then they say there was one special holiday. So the team has actually worked for only 19 days. Listen, the team has actually worked for only 19 days, but the team was supposed to be working for 20 days. Instead of 20 days, I have utilized only 19. Instead of 20, I utilized only 19. Instead of 20, I utilized only 19. My ratio has to be less than 100 because it is not a good sign. It is underutilization. It's an adverse variance. If it is underutilization, my ratio should be less than 100. If I want ratio to be less than 100, my numerator must be lesser than the denominator. So 19 will be the numerator, 20 will be the denominator, 95% is your calendar ratio. These three are discussed. Now actual capacity usage ratio is max to max you can work for 8,000 hours if you employ 50. There is a provision of working for 8,000 hours by 50 workers. You are completing work in 6,000 hours, guys. You have such a team which is working for 6,000 hours. You can actually work for 8,000 hours. So this is your 75% utilization of the available team. So this is actual utilization. And actually usage of budgeted capacity ratio. Actual usage, okay, with the available team. With the available team, I could have worked for 6,400 hours. I have worked for 6,000 hours. That means I have utilized team well, 93.75%. So this was about your ratio calculation. Actual capacity usage ratio was based on total budgeted capacity. Actual usage of budgeted capacity, where you actually considered the budgeted hours available with you, and they are 6,400. So that was your ratio related question. In standard costing, in fixed overhead variances also, they were asking some ratios. We did not discuss that in standard because I wanted to discuss this question with you in application topic. I hope things are clear. And the most important question was this. This was about treatment of under over absorption. This was your overheads incurred, and this was your overheads applied. Applied means absorbed. So I incurred 426,544. I should have absorbed 426,544, but I have absorbed 365,904. 60,640. 60,640. 60,640 is your under absorption. They said apply both the methods. So one method is treat that entirely as abnormal and transfer it to costing P&L. Your entire profit will go down by 60,640. Simple. See, because if it is under absorption, you have charged less. That means your profit is inflated. So if you transfer it to costing P&L, automatically that under absorption will be charged to costing P&L and profit will be brought down to the normal level. What if it is treated as normal? If it is treated as normal, we need to go for supplementary rate, and since we don't have quantity structure available, we considered final balance of these, final closing balances of these three accounts. And this is what we have done. If I assume it the other way, if I assume under absorption to be normal, this is what I'm going to do. If I'm going to assume this to be normal, this is what I'm going to do. Under absorption will be split into three parts on the basis of the cost ratio. 42,029 will be charged to cost of sales. 11,537 will be charged to finished goods, and 7,074 will be charged to WIP. But remember one thing. Yes, your profit will not be affected because of these two, because they don't give you profit, so they cannot affect the profit. Your profit will be affected only because of 42,029, because cost of sales goes up, profit goes down, because sales minus cost of sales is profit. If you are increasing cost of sales by debiting it, that means your cost of sales balance goes up. Sales being same, profit will go down. Sales being same, profit will go down. So in my first assumption, when it was abnormal, entire 60,640 under absorption was getting charged to costing P&L. Entire amount of profit was brought down. Due to this assumption, 42,029 will be the reduction in profit. There is one more option. Treat it as normal, but carry it forward to the next period. In that case, you are not adjusting profit of the current year. In the current year, you're getting it transferred to the next year for getting it adjusted or set off against the next year's over absorption. In that case, current year's profit will remain unaffected. This is what we have done in this question. Guys, there was nothing much to be done. Other questions are already discussed in batch costing. So, question number 8, question number 9, they were discussed in batch costing. Question number 10 was also discussed in batch costing. Question number 11 will be done in integral, non-integral. It was based on integral, non-integral. I'll solve that. Question number 12 was job costing, inclusive of absorption costing. So that part was also done. We discussed a few things like actual fixed overhead is not to be charged. We write absorbed fixed overheads. That's it. So I'll just simply discuss now question number 11 with you guys. They said, yes, They said there was a total production cost of 1 lakh. 8% was the damage. So 8,000 was your wastage. Not damage, basically wastage. 8% was your wastage. Out of 8,000, you could get 2,000 from the market, so your actual loss was 6,000. Then they further said out of the total loss of 8%, 2% was normal. That means balance 6% was abnormal. Since balance 6% was abnormal, the entire quantity was split in the ratio 2:6. So loss of 6,000 is split as normal abnormal in the ratio 2:6. 1:3. And 1,500 and 4,500 was or normal loss and abnormal loss respectively. And the entry for receiving cash, GLA debit 2,000. For abnormal loss 4,500, costing P&L debit. Normal loss is always charged to the customer as being part of cost of sales. It will go through production overheads. And since the loss is due to production cost should come down. And anything related to production, we all know that it will be charged to WIP. So it will be recorded through WIP. So it will be recorded through WIP. Is this part clear? If you want, you can copy this solution. Being loss in production adjusted. Being loss in production adjusted. So you can pause this video and get it copied. Total loss 1 lakh. Production cost it is. Total cost 1 lakh. Production cost. 8% is loss. So 8,000 is a cost of loss. 2,000 I could recover. So 6,000 is my net loss. Out of that, the actual normal abnormal ratio is 2:6. Okay. So normal will be charged to production overheads. Abnormal will be charged to costing P&L. Entry for receiving 2,000 GLA debit. We can't show cash bank to WIP. WIP balance goes down. WIP balance goes down. So there was an entry to be passed. So guys, that was your application topic. Rest everything is discussed in respective topics. You can refer to those topics. Your revision will be done. Don't worry about it. Thank you so much guys for watching this video. See you soon.